Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. And today I want to focus on 5 common tax deductions that went away in 2018. I got a call from a client yesterday who moved for a job, and they wanted to know, okay, well, how much of this is tax deductible? So it's like, yeah, it's time for us to really have a conversation about these tax deductions again. All right. So let's talk about that. So moving, the law before was that if you moved more than 50 miles from your current job, right, then you could deduct some of your moving expenses. That is no longer the case. Now, this does not apply to military people when they're moving based on orders, but for everybody else, if you're moving for a job, you can't deduct that. So in negotiating for a job, if you have to relocate, you want to make sure you negotiate that in your package for the company to move you, because you cannot deduct those moving expenses on your taxes. Now, I know some jobs do a partial reimbursement, which that could be also counted as income to you. So you definitely want to check with your HR, and when you're negotiating, moving for a job, you need to negotiate that, because it's no longer tax deductible for you. Okay. All right. Number 2 is personal exemptions. Okay. So before, right? So before, you had your standard deduction and your personal exemption. So your standard deduction for an individual was $63.50, and then your personal exemption was another $4,000. So you had $10,050 of a reduction in income, right? If you're a single person. If you were married, then, you had, gosh, what was it? I forgot already. Gosh, $12,000 or so. Yeah, it's like $12,000 if you're married filing joint. But for every dependent, you had a $4,050 exemption. Well, people heard about the doubling of the standard deduction, which is great for single people. It's $12,000. Married filing joint is $24,000. And head of household, your standard deduction is $18,000. However, the personal exemptions have gone away. So this is really going to affect people that have is larger than a family of 4. And if you have children who are in college that you're still helping to take care of, because you could still claim them and claim the personal exemption. But now that personal exemptions have gone away, it really doesn't benefit you. And there are a lot of people that are going to be losing out in that part of their tax return, to where, if you were claiming between your standard deduction and your standard deduction, your personal exemptions, if you may just be losing out here, period. So if you had more than $24,000 in between those 2 line items, you're going to be losing money in this portion of your tax return. Now, you may have small children where you can benefit from the child tax credit. But if you've got children 17 or older that may be in college or a senior in high school, it doesn't benefit you, because those personal exemptions are gone away. And the child tax credit does not apply for kids over the age of 17. Okay. So that is number 2. So you really need to do the math on your return, looking at what your return looked like for 2017, and look at what your deductions were, whether you had the standard or itemized deductions, or if you had, what your exemptions were. If you had the child tax credit, you've got kids that may have aged out. So that's going to change for you. Okay, the next one is since we're talking about deductions, let's talk about these itemized deductions that are gone. I got my notes here, so I want to make sure I cover everything. All right, so the itemized deductions are pretty much gone. Okay, and so what that means is, I'm finding my notes over here so I can make sure I get this right. Okay. So with your itemized deductions, where you had the Schedule A is what we're talking about here. So when you're looking at your itemized deductions, we're talking about, your state and local tax deductions, property taxes, unreimbursed employee expenses, investment fees, all of this stuff. All of those deductions on your itemized deductions are gone. Okay. And so that's all being lumped in that doubling of the standard deduction. So people heard the great part about, the standard deduction is going to be doubled, but what is being taken away, that part did not seem to really get to get to the people. Okay. So you're going to have that portion of your tax return that's just gone. So like I said, when you look at your previous year return, your 2017 tax return, if you had itemized deductions, if you had, those investment fees and all of that, there were, like the unreimbursed employee expenses that you had a 2% floor that you had to exceed in order to be able to deduct those. Nuts and bolts is all of it's gone. People asking about about charitable deductions. Well, that's if your charitable deductions exceed your, and your state and local tax deductions, which I'll talk about next, if that exceeds your standard deduction, then you'll get to deduct that, get that additional benefit. But if you don't, standard deduction. So those things are essentially gone because there are limitations on the state and local tax deduction. So let me talk about that real quick and we'll put it all together and see what you get. All right. So your state and local tax deductions, they're limited to $10,000. So those are your state taxes that you pay, your property taxes that you pay. If you pay any, there's personal property taxes, there's real property taxes that you pay for your state. Well, all of that's capped at $10,000. So if you're a high wage earner, or if you live in a high income tax state, like the folks that are in the New England states and New York and California, all that, people are ticked, right? And was like, okay, we need to go move somewhere else where there's lower taxes. Okay, but New York ain't having that. That's a whole other broadcast. But with these deductions now being limited to $10,000, you're going to have a heck of time of exceeding your standard deduction. Okay. You're talking about if you're limited, because that was the biggest part of the itemized deductions, right? Is that your mortgage interest, all of those things were the biggest things on your Schedule A, the itemized deductions. And now that there's a limitation on that, there aren't going to be a whole lot of people itemizing. Now, the standard deduction, people feel like, okay, if I only take the standard deduction, I'm being cheated. Well, that's not necessarily true, because if you already didn't have the amount of deductions anyway, then you got a bonus. But now people are like, okay, hold on. So you're capping me at this $10,000. I can't deduct other stuff. And so I have charitable donations. But if between the state and local tax deductions and your charitable donations and maybe your medical expenses, if you don't, exceed your standard deduction, you're going to get the standard deduction. But people are ticked because of this limitation of the state and local tax deductions. And what some people were doing was like, okay, I need to move from New York to go move to a state like Florida. So I was reading an article where New York is going, hold on, buddy, because what you're going to have to do is you're going to have to really prove to the state of New York that you have left New York permanently. And proving that does not just mean, going to get a different driver's license, voter registration card, and all that. They want to know exactly how many days that you spent in that other state. And you have to be able to prove that. And if you spent one more day in New York than you did in that other state, then guess what? You're still a New York resident. Okay. So the states are putting measures in place for people that decide, okay, we just go up and move. That, okay, no, it's not going to be that simple. But other states, lower income tax states, are trying to woo those people. They wooing, y'all. Lower income tax states is wooing people to come to their states. But the higher income tax states are putting measures in place where moving is not just going to be this easy thing to do. Okay. All right. So number 5, I think we should be on number 5 by now. All right. Unrestricted deductions for home equity loan interest. All right. So this is another one that I think people really just didn't catch. So lots of people have home equity loans, okay, for different reasons. You may be doing, improvements on your home. Some people take out take out home equity loans to pay off debt and all this other stuff. Okay, you can no longer deduct home equity loan interest. I don't care what it's for. Okay, it's not being grandfathered in or anything like that. You can no longer deduct it. So, you know, so when you are, so it's like, how do we use this information to prepare for next year? Well, you got to go do the math. You got to go look at what if you itemized or if you had the standard deduction, how much was your exemptions? What were your total deductions in all? All of that matters. Now, for home business owners, and a lot of these things get to stay. For if you own rental property, you can still deduct the interest, because I think the cap on the mortgage interest is $1 million, but you can still deduct that, and you can still deduct the fees that are related to your rental property. But for your personal property, that stuff is gone. Okay. If you're, like I said, if you're moving for a job, then you really need to negotiate a relocation package to help you with the expenses for moving a family. Because listen, moving is expensive, even if you just have to pay for the in-transit stuff like food and hotels and whatnot. Moving is expensive. So you really need to negotiate that going in. The home equity loan interest, how much of that are you paying? Like, you really need to look at that. Your loan, your mortgage interest is capped at the first $1 million for your personal residence. So anything above $1 million, you can't deduct that mortgage interest. And some folks are like, $1 million? Do you know what I could get in $1 million? It depends on where you live, okay? Because $1 million in the South, you can buy, 45 acres for $1 million. I'm just using that number facetiously, okay? But you can buy a whole bunch in the South for $1 million. When you go to the Northeast region, okay, $1 million is going to get you a Matchbox. If you go to California, some of there's $1 million is going to get you a Matchbox. Okay. It's not going to get you a whole lot. So, to limit that, personal, that, what's the word for it? Your residence, your primary residence. That's the word. To limit that, the interest on your primary residence to $1 million. There are some people that are going to be losing out on that mortgage interest. Okay. So I think that's it, you guys. Oh, and the bonus one is if you're going through a divorce, okay, the deduction for alimony, it ends December 31st, 2018. So what that means is if you are the payer of the alimony, it's a tax deduction for you. If you're the receiver of the alimony, it's taxable income. But that changes December 31st, 2018. Okay, starting January 1, 2019, it is no longer tax deductible for the payer and it's no longer taxable to the receiver. So if you got somebody on either side of those spectrums, you better, y'all need to work it out. Okay. That's all I got to say about that. All right. Hopefully you are not in that boat, but I know a lot of people are. All right. So this is just really something for you to chew on, to really, to take the time to look at your tax returns and see, and try to gauge your best, like people like, how is exactly this is going to affect me? Like really, we really don't know until we put the numbers in, like to really see how it's going to affect each person individually. It's going to affect everybody differently, period. But you just got to do the math, and you need to, this is the time, when it's slower, like during the summer, early fall, to sit down with your CPAs, your tax professionals to say, hey, can we really look at this to see what this is going to look like for us, for the coming year. So you can be prepared for that. Because in some instances, people are going to see higher tax bills. There are going to be some instances where people are going to see higher refunds. Tax cuts, they don't they just don't pan out for everybody, period. I don't care which side of the aisle that you're on. They just don't pan out for everybody. Somebody's going to win. Somebody's going to lose. You just got to figure out where you are in the midst of it all. All right. So thanks so much for tuning into Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see y'all next time. Bye.